The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
No horsing around. The record rally resumes for risk assets, and so too for safe havens. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let me tell you about it. Right now, we're seeing that bounce back, as Romaine mentioned. The S&P 500 up about 0.5% after a slight decline yesterday. It's being led by big tech. The Nasdaq 100 higher by about 0.9%. AMD continuing its rally. Nvidia, too, getting in there. I wanted to highlight the 10-year Treasury yield. We had an auction earlier today. It tailed slightly. You can see that bonds selling off just barely right now, sitting at 412 when it comes to your benchmark. And then the VIX, wanted to highlight that as well. We were above 17 yesterday, Romaine. Haven't been around those levels in feels like a while, but right now you can see volatility coming out of this equity market back in the 16s.
Yeah, interesting price action today, and yesterday's rare dip in equities. Well, it did provide a bit of an opening for the bulls to double down on the recent record rally. And while Goldman strategist Peter Oppenheimer says tech valuations are stretched, they're not yet at historical bubbleiciousness. Moreover, he sees valuations across equity and credit markets as more a reflection of lower interest rates, higher global savings, and an extending economic cycle. But there is one big risk out there, the risk that everyone's talking about, and that is tight correlations between asset classes and now within the AI ecosystem itself. Recent compute deals appear curiously circular in nature. Chip makers staking AI companies investing in chip makers, all with agreements for boomerang sales and services in reciprocity. In the short term, that's great for bolstering valuations, but it does leave investors vulnerable to sudden correction. And maybe that's a big reason for the near unprecedented gold hedge that has pushed bullion toward its best annual performance since the 1970s, smashing through $4,000 an ounce. Uncertainties out there over global trade, Fed independence, and U.S. fiscal stability. Part of that debasement trade that I talked about earlier this week, a notion that the head of fund management for Canada's pension board today said may eventually cost U.S. Treasuries, Katie, their safe haven status.
Yeah, a lot of concerns there when it comes, of course, to the status of treasuries, when it comes to the status of the dollar and how global investors are viewing it. But let's go back to that stock market and the bounce back that we're seeing. One potential reason why we're seeing dip buying right now could just be there haven't been many dips to buy. If you take a look at the S&P 500, it's been within spitting distance, about 2.5% of its record high since June. In fact, it's been about over 80 days that we've broken below that. That is the longest stretch since 2021. So we are in a market, it feels like, Romaine, where if you see a sale, you just jump in. That's what we're seeing today.
Absolutely here, but a big questions here about what we see in the short term and what could play out over the long term. Ronald Temple joins us right now to kick us off to the close, Chief Market Strategist over at Lazard. Great to have you here.
Great to be here.
I am curious about the difference between what we're seeing in the short term and some of the chasing of this rally and some of the more long-term concerns that would seem to suggest that maybe we are getting a little bit far ahead of ourselves with regards to, at least with regards to U.S. equities.
No, I do worry that we're seeing signs of what looks like a bit of a speculative melt-up. I mean, maybe that's an overstatement of what we see so far, but it does, when I look across asset classes, it's very hard to find any asset class that looks cheap right now. And when you step back and think about policy unpredictability, questions around the size of fiscal deficits, not just the United States, but across developed economies, look at questions around sustainability of growth rates, it does seem that asset prices might be getting ahead of the fundamentals.
I mean, underpinning that, and at least this would be the argument by the bulls, is that when you look at the AI trade, which has more or less been the trade in equity markets for the last couple of years, that there is sort of a promise of something big on the horizon. Whether that translates into actual profitability, who knows? But certainly on a top-line revenue basis, there is potential there. Do you not see it?
No, I think I do think AI is likely to be one of the biggest economic transformations or disruptions of our lifetime, and I think there is a lot of promise. But I do worry that we keep seeing these bigger and bigger capital investment announcements, and yet we don't really have any sense of when the return on capital will arrive and what that return might look like. And so, you know, we've literally gone from, I believe in 2022, $20 billion going into AI to 2026, the estimate's closer to $500 billion. And when I think about the economy, by the way, I do worry that in the first half of this year, a majority of the GDP growth in the United States was directly attributable to AI and the build out of infrastructure around it. And I also worry, by the way, for that growth to be extended, you need that hockey stick to keep going higher. I mean, it's not good enough to level off at $500 billion a year. You have to keep increasing it. Right. So it is worrisome.
Right, the numbers have to get bigger there when you think about the expectations that are being inflated right now. But Romain brought up an interesting point in his intro, which is basically you have these companies becoming more and more connected with these overlapping deals, those circular deals. It kind of, in a sense, ties their fortunes together. And, you know, when you think about all the reasons to maybe worry about that, the idea that we could face a sudden correction that takes down one and knocks the others down a peg, it just feels like maybe that correlation is getting stronger than it has been previously.
I agree. I think that's a very legitimate concern. When you see basically financing your customers' purchases, that's worrisome, especially in a case where, back to that prior comment, we don't know when the returns on capital will arrive. What if investors decide they don't want to deliver the next 10, 20, 50, $100 billion of capital for the investment to continue? So it seems that we're building a riskier story around AI. And yet for investors, I think the challenge is we see this massive economic opportunity. Between here and there, there's a lot of uncertainty.
Right. The path to get there isn't necessarily linear. I do think it's telling that, you know, we're several minutes into this conversation. We haven't brought up the government shutdown yet. The U.S. government still isn't open, Ron, and I think that speaks to the fact that it seems like markets aren't really concerned. Do they need to be, and at what point?
Now, historically, government shutdowns really have not moved the economic needle that much. But let's be very honest. We haven't had many full shutdowns of the government. Up until 1980, when there was a funding gap, the government would just keep operating because everyone knew it would be resolved. And we've only had, I think this is technically our fourth full shutdown. Depends on where you look. Some people call the 2018-2019 shutdown full, but 5 of the 12 appropriations bills had been passed that year.
Good point.
So it's only the fourth time we've done this in full. The last time, 2013. I worry that the longer it extends, the more damage it creates to the economy. And I think what's also different this time is we do have the president threatening to permanently terminate a lot of these employees. Historically, when the shutdown ends, everyone gets their back pay, they go about their business, they pay their mortgage, and things are fine, and there's a very small decrement to GDP. If you had permanent layoffs, that would be different.
Well, that's what I'm curious about, too, and what the threats that are coming out of the White House, certain changes, the complexion. But I'm curious about the labor market, because heading into this shutdown, we were already concerned about the idea that there wasn't a lot of hiring going on. Not a lot of firing, but not a lot of hiring either. Not necessarily a dynamic labor market. When you take all these government workers that could maybe find themselves, some of them, permanently out of a job and maybe having to re-enter the labor market and look for jobs, does that cause you concern that we could start to see a skew in the labor market that could affect the overall economic outlook?
I mean, it's probably more isolated in those parts of the country with higher representation of government workers. I think in the aggregate, you know, it's probably not going to move the national unemployment figures or the national wage growth story. But again, this is all on the margin, right? We already have a softening of demand for labor in the economy. We have also a softening of growth of supply of labor, which has already made the whole unemployment story more complicated. And hopefully soon we'll get the unemployment data from last week. But bottom line is, you add on these government workers who are having to work without pay, the ones who are being furloughed and not being paid, that's a decrease in consumption, so that weakens the economy. And let's not forget, by the way, there are even more government contractors who are not government employees. Those contractors are not being paid. So, you know, if you work for that consulting firm, you still expect to be paid by the consulting firm, but the consulting firm is not being paid by the government during the shutdown. So it does add up, and on the margin it's negative, but I don't think it's alarming. I mean, I think that's why the market's looking through it, is saying, well, this will pass.
Right. And I mean, the market is looking through it. The Fed can't necessarily. The Fed has to make a decision at the end of this month. And maybe at that point, the government will be open and they'll have some measure of delayed data. But when you think about the needle that they have to thread between, OK, it seems like the labor market is softening. I think we can say that. But then you think about inflation and where it is and the concerns that not only will it remain sticky, but it might accelerate. How do you begin to thread that?
I think it's really complicated. We just got the FOMC minutes about an hour ago, and having read through them, you get a lot of on the one hand, on the other hand. You know, a few said this, several said that, some said this, most said that. I think the challenge at the Fed right now is it's a really murky economic outlook. I believe the break-even rate for job creation relative to unemployment has declined materially. 10 years ago, we needed 140,000 jobs per month to keep a stable unemployment rate. I think that number now is below 50,000 because of changes in immigration. And basically, that's going to drive uncertainty. And the market, by the way, seems to be looking at non-farm payrolls and saying in the last 4 months, 27,000 jobs a month, cut rates. Not so clear. On the other side of the equation, we've got tariff inflation. In the month of August, the average tariff rate that was actually charged on imports was only 11.5%. Before yesterday's heavy truck announcement, the announced tariff rate is 17.9. So there's a lot more of that tariff cost that's still going to come into consumer prices. So I think core CPI will be around 4% by the first quarter of next year. So put all that together, accelerating inflation, unemployment that maybe moves marginally higher. And the Fed doesn't have the data they need right now to make a decision. It's a really tough spot.
Yeah, and that's a good point, because we look at those minutes and you see there was a serious discussion about inflation, and inflation report we were supposed to get next week, which doesn't look like we're going to get it because of the government shutdown. Ronald Temple is Chief Market Strategist over at Lazard, kicking us off to the close here on this Wednesday afternoon. When we come back, we're going to talk about the private sector as investors look for new plays. CAIS CEO Matt Brown, he's going to break down why alternatives may be the next big move in the market.
Plus, speaking of big moves, NBA legend Shaquille O'Neal is teaming up with Jacmel Partners co-managing partner Jorge Mora. How he's bringing his larger-than-life presence from the court to the world of infrastructure. Yeah, Shaq in infrastructure right now, and a conversation about what's going on in the residential building space. HGTV star Tarek Moussa going to be joining us in just a second as well. Stick with us. This is The Close on Bloomberg. Well, NVIDIA and OpenAI's billions of dollars in AI deals raising concerns about circular funding. First, OpenAI agreed to buy millions of NVIDIA chips in exchange for NVIDIA putting $100 billion toward its AI build-out. Then it secured a deal this week with AMD to use billions of dollars worth of its chips. Let's drill down into what this all means for the industry with Mandeep Singh, global head of technology research over at Bloomberg Intelligence. There was an Oracle OpenAI partnership in there as well in those weeks. And as I mentioned, there are concerns out there that you have these overlapping deals that in some cases seem circular in nature. That's raising concerns that we're watching the bubble inflate in real time, especially when it comes to stock performance. And from where you're sitting, as head of global tech research, I wonder how you think about some of those concerns.
I mean, for us, the biggest metric is consumption and, engagement. And when you look at a company like Google, which was at the forefront of getting disrupted because of, generative AI, their token consumption has grown 50 times over the course of the past 1 year. 50x. Now imagine the power hasn't grown more than 2x, even though these hyperscalers have spent over $300 billion this year. The power has grown maybe 10 gigawatts. Sam Altman just signed deals for 16 gigawatts worth of power just this week. So that supersedes that, all the power that we have added this year. And given Google's token consumption grew 50x, I mean, all these companies can see the usage. They can see everyone is consuming generative AI, and we know power is the constraint. That's why they are signing all these deals. And look, these are big numbers. So OpenAI cannot finance it themselves. Google can. They have the balance sheet to put their money to build the data centers. OpenAI cannot, which is why they are going for all these type of deals.
Well, this is what I'm curious about. And the idea that OpenAI cannot, I mean, that's really key here, because we think about just how this company has just sort of taken over the zeitgeist. The fact of the matter is they can't fund this dream themselves. And Sam Altman has been pretty clear about that publicly as well. But when you start to add up the numbers, it doesn't seem like anybody can fund this dream if you believe these, $2, $3, $4 trillion price numbers that people are putting out there for the type of investment that we're going to need.
But again, the key thing here is with $300 billion in CapEx this year, we have seen a 50x increase in usage for these type of products. So why would you not invest given you are seeing the usage? There is demand. Monetization, I think that's a concern. Everyone wants to know what is the business model. If it's not ads, will subscriptions going to be enough? Those concerns are there, but the usage is very
The
visible.
usage is real, right?
Yeah.
The usage is real, but the interconnectability that, Katie talks about with kind of the snake eating itself, is that not a concern? I mean, just from a fundamental analyst perspective, when you look at some of these companies and you see, it does seem like a lot of self-dealing to a certain extent.
So the field of LLMs have narrowed over the past 12 months, and I feel it could narrow even further. A company like XAI, yes, they raised $20 billion today, but they will struggle to catch up to someone like OpenAI, which is doing, probably $500 billion worth of deals with the two that they had these 2 weeks. So from that perspective, you really need the scale and the balance sheet to really move forward in this, because otherwise, the company with scale will have more capacity, they'll have more users, they will have more efficiency in terms of running their infrastructure, and that's where users will end up going.
All right, what did you call it, Katie? The
Ouroboros.
Ouroboros.
Yeah.
Mandeep Singh, Global Head of Technology Research, and now Global Head of Ouroboros? Is that it? Over at Bloomberg Intelligence. Anyway, the Bloomberg Big Take, a great read today here about some of the OpenAI deals out there and some great research by BI as well, explaining why it might not be as bad of a thing as some people want to believe. When we come back, bank earnings on tap for next week, a preview when we come back after the break. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with FedEx. JP Morgan cutting to neutral. The analyst says near-term profitability remains under pressure from tariffs and says the shipping transportation sector faces, quote, abysmal market sentiment. Those shares down for a second day. Next up, Intel, HSBC downgrading to reduce from hold. The run-up in the stock after investments by NVIDIA and others is not sustainable, the analyst says. And while more deals could support the stock near-term, he says long-term, the only deal that could fundamentally change anything would involve technology sharing with TSMC, and he does not actually see that happening. The share is given a slight bid on the day, up about 0.25%. And finally, Tesla. Stifel raising its price target to $483 from $440 on the back of Tesla announcing new versions of the Model 3 and Y priced under $40,000. Those shares up 1% on the day, and those are some of our top calls. We do want to turn to the banking sector. We're expecting to get earnings out of the big banks starting next week. Citi, Goldman, Wells Fargo, JP Morgan, just to name a few. Betsy Graseck covers them all as Global Head of Banks and Diversified Finance Research over at Morgan Stanley. Betsy, great to see you here.
Thank you so much for having me.
Let's start off with the record run in stocks, which of course is potentially going to lead to maybe some record revenue gains with regards to the trading businesses of some of these banks. Expectations are, at least across the board, double-digit growth in that business.
I think it depends on the bank. Some have suggested mid-singles year on year, and some have suggested low doubles. So it does depend on the institution for sure. Part of it is a function of where the market is, and part of it is a function of the fact that we have a really strong issuance calendar, and primary issuance is supportive of better trading opportunities.
You say calendar, that assumes that what we've gone through so far over the last few months with that pickup in issuance, you expect that to accelerate?
Well, we're talking about the quarter, right?
Yeah.
And so we have had an acceleration in this quarter in IPOs, for example, right? So that should be supportive of equity market trading revenues.
So we can talk about trading, we can talk about capital markets. I do want to talk about deposits and deposit rates, because we were having a great conversation with Jerome Schneider from PIMCO yesterday about this march into money market funds that just seemingly won't end. His view was that only 8 to 10%, I think he said, was risk-seeking assets, money that could come out. A lot of that is people who have gone into money market funds instead of being at banks and keeping their cash there and parked there in the form of deposits. And already you point out that banks are starting to drop their deposit rates as we see Fed rates come down.
Yes.
Well, if you could give us some context, I mean, when it comes to attracting those deposits back, is that a big concern for some of these big banks, or is that basically a detail when you think about their trading powerhouses?
Well, I think there's a lot of questions wrapped up into that. So let me just tick through them in the sense that for this quarter, I do think that we will have solid earnings, even a little bit stronger. We are, for the most part, above consensus on our estimates for this quarter's results. And part of the reason is the really strong capital markets continues. M&A, for example, volumes up 40% year on year. And we also have strength in IPO activity. We have strength in debt funding activity. And then on the trading side, as we just discussed, mid-singles to double digits year on year is a very solid result. I do think we're positioned for a little bit of a beat of what managements had been guiding to a few weeks back, just as the quarter has closed fairly strong, in our opinion. Now, on the deposit side, deposits, loans, we look at the H8 data every week for that. And we have loan growth in the large banks at just under 5% year on year. It's been holding steady there for a few weeks, and it's, again, pretty solid. And the deposit side is running at about 4% growth as well. So while we do have liquidity shift into money market funds, deposits are still growing. Deposits are not, deposits are still growing. And what we are seeing in banks overall is deposit rates have been stepping down in line with Fed rate cuts. We're also seeing a little bit more of a decline for institutions that have a skew to CDs.
Right.
As CDs roll over, you're going to be getting a better, cost of funds.
And when you say that deposits are growing, is that true across size levels, or is there a difference when you take a look at some of the small to mid-sized banks versus the JP Morgans of the world?
In fact, and this is just coming from the H8 data, we see it every Friday after the close. And what we have seen is small bank deposit growth is actually a little bit faster than large bank. Yeah. Order of magnitude 1 to 2 percentage points faster depending on the week. So as earnings does unleash next week, we will be getting all the details for you, and be sure to send them over. But as it stands today, we do think that balance sheet growth is solid, supported by solid deposit growth.
All right. Well, Betsy, you have a busy couple of weeks coming up. Great to preview some of the action with you. That is Betsy Graseck. She is Global Head of Banks and Diversified Finance Research over at Morgan Stanley. Now, coming up on the close, Matt Brown. He's the founder, chairman, and CEO of CAIS. He joins the program next. We'll discuss the, quote, record demand they're seeing for alternative investments. Don't want to miss this one. This is the close on Bloomberg.
So now there's that urgency of saying, okay, it's time to try to get access to this and get more exposure. Yet where the partnerships are coming in is the fact that, well, like the technology is still not there, right? Look, and even in my previous firm, we had products and annuities and things that were far superior than what was out there. Yet because it was clunky, because it was hard to hit an easy button, people were willing to take the lower return. You go to wealth advisors today, platforms, most of their models say 20% owns. Yet 3% would be a pretty high allocation.
Part of my conversation with Jose Minaya, the global head of BNY Investments and Wealth, that was at the Greenwich Economic Forum. And as I'm sure you know, Katie, all the talk, once again, is all about alternatives and how that sort of funnels through into the wealth channel.
Yeah, I'm sure you're having a bit of deja vu because that was the talk of the town this time last year. Maybe not quite the year before, but certainly that has been the conversation. Now it's also about how to get retail investors access to some of those private market investments that we know are red hot right now.
Absolutely, yep.
Well, let's keep this conversation going now with Matt Brown. He is CAIS founder, chairman, and CEO, joining us on set. Matt, great to see you in person.
Great to be here. Thanks so much.
So I take a look at the notes you sent over. This is in bold, that you continue to see record demand basically for alts. And alts is a broad church. So I'd love to get some more detail on that. When you say alts, are we talking about real estate? Are we talking about private credit? Are we talking about private companies?
We're really talking about private markets, so private credit, private real estate, private equity largely. And I think you're absolutely correct when you say the demand is kind of at record highs. When you kind of peel it back and say, okay, what's different now than maybe 3 years ago or 5 years ago? There's a few things happening. If you look at the advisor side of the equation, who represent their clients, their investors, and you take a look at the fact that 80% of companies in America that have revenue over $100 million are private. So if you're in charge of a portfolio to maximize return for your client, how can you participate in the growth of America if you're not investing in private markets? And that's what the financial advisor community is really seeing now. And that's what's driving on the advisor side the demand for more and more alts and making alternative investments in private markets really a staple in a well-rounded modern portfolio. But what is less talked about, I think, is the other side of the equation. It's the alternative investment managers themselves.
Yeah.
They're looking at a $50 trillion pool in wealth management with allocations to alternative investments at 3%, 4%, as Jose just mentioned.
Yeah.
When institutional allocations for alternatives can be 40 or 50%. Yeah. If alts just go from current levels to 10 to 15%, that'll be $10 trillion of new capital coming into alternative investment funds.
Are the advisors prepared for that in terms of being able to educate people, having the products ready for them?
Yeah, we hope so.
Yeah.
And on the CAIS platform, we actually leaned in with advisor education on alternative strategies and alternative products from day one. We have a term called lead with learning. We always felt that the best advisor needs to be armed to be able to have all the facts about the product and also to be able to talk to their client about the risks of having some illiquidity in their portfolio.
Right. Well, that gets into an area that I'm really interested in, and that is how you actually access private investments, what vehicles specifically you use. I live in the ETF world, for example, and the puzzle of how you fit private assets into an ETF, which of course is as liquid as water, that's one of the thought experiments in the industry right now. But I mean, when you say that advisors want this on behalf of their clients, how do they go about thinking about that, trying to put basically an illiquid asset into a portfolio?
Well, most of the investments are presented in funds, fund structures, diversified portfolios of private markets. But there's been a lot of innovation in the actual, and this is a bit technical, in the fund wrapper in terms of making it a little bit easier or more scalable. Going back, 5 years and more, most private markets were only offered in institutional wrappers, which mean very high minimums, $5, $10 million per investor. They were locked up for 10 years. That's really kind of a square peg in a round hole for the financial advisor community. They may have $10 million of demand across their entire client book, but how do you break it up into smaller amounts so every client can have private markets in a portfolio? So with the rise of registered products, which is what we're seeing right now, these are open-ended or evergreen, so there's no drawdown structures to them. They're offered in lower minimums, and they're also offered to investors that are not just the wealthiest, but also kind of that mid-level accredited level. So it's a broader audience, more exposure.
I am curious about some of the partnerships that we've seen between, I guess, what would traditionally be the public market side of the business now with the private market. And I think the argument, at least that the traditional big finance companies would make is, you're entering a world now where there's a lot more paperwork, a lot more regulation, a lot more back office stuff that some of the alt firms necessarily aren't prepared for. Is that valid?
I think so. Yeah. They're getting up to speed quickly, but
Okay.
Yeah.
So you expect to see more partnerships, even M&A in that area, maybe?
You're seeing a convergence of public and private markets, for sure. You're seeing it in M&A. We saw BlackRock and HPS merge, so that's kind of an example of a traditional asset manager and an alts manager coming together to have a broader platform of offerings. You're also seeing it in product creation, which I think, Romain, you may be referencing.
Yeah.
That's where like an Apollo and State Street come together and create one investable product, like an ETF, that has both public and private markets in the same product. So think of that like a one-stop shop. You saw Blackstone do that, I believe, with Wellington. I think we said KKR do that with Cap Group.
Yeah.
So I think there's some experimentation going on, but the key here is that we've always stood for the past 15 years, responsible democratization of alternatives. We want it to be done the right way. We think it's in the best interest of investors to have exposure of private markets, but it can't be done in a way where, say, we're trying to gamify structure for distribution purposes.
Gotcha.
And we keep a pretty close eye on that.
Well, you bring up, for example, State Street's product, their private credit ETF that was in partnership with Apollo. Apollo has since been dropped from the name. The SEC had some opinions about that. But in any case, it hasn't seen exactly barn burner demand. There was a lot of hype about that product coming out, and it hasn't seen much in the way of inflows. And one of the reasons for why that I've received is that, okay, the self-directed retail individual investor, private companies, that's easy to grasp. Private debt, maybe the demand just isn't there as much. So from what you're seeing, when you take a look at private equity versus private debt, what does the relative demand look like?
I think the demand issue is less about private equity versus private debt. I think what you're seeing is the investor community trying to understand two very different public market and private market delivered in the same product when forever they've been separated with different decision making. So I think there's long-term positive hope for products like that, but I do think there's some maybe slower adoption.
Yeah, Matt, we only have about a minute left. I'm sorry to cut you off, but I do just want to get your thoughts too, and just the evolution of things. I mean, you go back to why you founded CAIS and the idea of it being sort of a platform, sort of a funnel for alt investments, and that was what was that, 09 or something? That was a long time ago.
That was a long.
You have a conference which kicks off next week.
Correct.
That has grown also in the 3-4 years that you've done
Fourth
it.
year this year.
Fourth year that you've done it. What has that evolution been like? I mean, what was it like in 09 when you were making calls and trying to get people on board with this relative to what you're walking into next week with your big event out there in Los Angeles?
If you go back to the earliest years of CAIS, this topic that is everyone's talking about wasn't being talked about. We were very early on this, creating the first technology platform that connects alts managers with the wealth community. Now, we can't get away from the conversation. It's on the top of everyone's mind. And you can see that in the reflection of the attendance in our summit. Year one, we were hoping people would show up. Year four, we have capped it at 1,200, and there's 3x demand to still come. So that just really reflects that it's on everyone's mind. Advisors know they want private markets and need them, and alts managers know they want to grow their businesses with wealth management clients.
All right, we have to leave it there. Matt, great stuff. Matt Brown is the founder, chairman, and CEO over at CAIS, and his fourth annual CAIS Summit kicks off next week out in Beverly Hills, California. When we come back here in New York, we're going to focus in on our stock of the hour, and it revolves around a private company, a bankrupt auto parts company. Jefferies, one of the stocks, taking a leg down on exposure to it. That's our stock of the hour, and it's up next, right here on The Close on Bloomberg. Time now for our stock of the hour. Taking a look at shares of Jefferies, down for an 8th straight day, down about 7% on the day. Concerns tied to the asset manager's roughly $715 million investment in the bankrupt auto parts company First Brands Group. Katherine Doherty joins us right now to talk a little bit more about what we know. And this has kind of been a slow trickle. I mean, we had the bankruptcy. There were rumors about a few other firms that had outsized exposure to some of the debt. And now Jefferies apparently is involved in this. What do we know?
Yes. So Jefferies is involved in a number of ways, but I want to make it clear that the exposure, the potential losses that analysts are starting to add up based on what the bank disclosed this morning are much smaller than that $715 million that you're mentioning. That $715 million, that's tied to Point Bonita Capital. And Point Bonita is an asset management firm, and it has a portfolio of the $715 million. This is in receivables. This is due by First Brand customers. It includes Walmart, it includes AutoZone, and normally those receivables are paid, sent to Point Bonita Capital, and Point Bonita is tied to Jefferies because Jefferies has a stake in Point Bonita, but not everything is going to be directly tied back to that $715 million number that keeps getting floated today. The other exposure that Jefferies disclosed was through various CLOs, and that exposure was also through Apex Credit Partners, and they held about $48 million of loans to First Brands, and Jefferies has a 50% stake in Apex Credit Partners. So they're basically going through and ticking and disclosing to their investors to quiet the noise. But what you're seeing today is through all of this, it's not just Jefferies. We've heard from UBS. We've heard from Western Alliance. These firms are coming forward and they want to give more disclosures to their investors to make sure that they understand exactly what the potential exposure is moving forward.
Katherine, we only have about 30 seconds left, but the plot thickens because you also broke the news that BlackRock is basically requesting to pull some money now out of Point Bonita.
Yes, so that fund that we were just mentioning, we have reported today that BlackRock and others have requested to pull some money from those funds. So that is going to be the next chapter of this story, is when the disclosures are out, it is up to the investment firms, it's up to the LPs to make the decision whether or not they want to keep their money in these funds or look for other funds that might make similar announcements. And this is just, I think, the beginning of a very long story.
Absolutely. The next chapter, I'm sure that our team over at Bloomberg News will be writing it. Great reporting, as always. That, of course, is Bloomberg's Katherine Doherty. Meanwhile, we're about 15 minutes away from the closing bell. We'll take you there with Aoifinn Devitt. She is Senior Investment Advisor over at Moneta. That's next. This is The Close on Bloomberg.
I do think AI is likely to be one of the biggest economic transformations or disruptions of our lifetime, and I think there is a lot of promise. But I do worry that we keep seeing these bigger and bigger capital investment announcements, and yet we don't really have any sense of when the return on capital will arrive and what that return might look like.
Ron Temple, Chief Market Strategist at Lazard, kicking us off to the close 50 minutes ago, 10 minutes until we get to the bells, and it looks like, Katie Greifeld, we're going to get some record highs today.
Yeah, big time. Some big dip buying. You can see that underway in the S&P 500. You can see it underway in the NASDAQ 100. Those chip makers up once again. AMD continuing its rally. So too is NVIDIA. Not too much going on in the bond market. Remarkably well behaved at this moment when you take a look at the 10-year Treasury yield. The VIX, volatility coming out as stocks resume once again their climb. Currently trading with a 16 handle on your fear measure.
What happened to the tail?
The tiny tail in the Treasury market.
The tiny tail in the Treasury market here. Well, markets, at least right now, seem to be taking it in stride, cross-asset-wise, as we count you down to the closing bells. Aoifinn Devitt joins us, Senior Investment Advisor over at Moneta. And Aoifinn, I do want to start off with the rally. Yesterday, there was a lot of hand-wringing about whatever was going on with Oracle, about the reports that maybe, just maybe, this AI trade isn't as profitable as some people want it to be. And what we saw, that was just pretty much an excuse for the bulls to come in today and buy into that dip. Is that going to be the cycle that we continue to see?
I think it will be the cycle that we look to any potential warning sign as a canary in the coal mine. That's really our job as commentators, as strategists. We have to look for those warning signs. We've been focusing on this narrative that we cannot really join the dots forwards, only backwards. So how can we predict the next downturn? Only by looking at these potential alarm bells. We're seeing it in AI, whether it's a bubble or not. And I heard you speak earlier about First Brands. We need to look at whether there's also some kind of an alarm bell ringing in the credit sector too.
Well, yeah, well, that's a good question, though. But I mean, right now, at least on the surface, you don't really see anything, right? You have stocks at record highs. You have credit spreads at the narrowest that they've been in years, probably at least more than a decade right now. And of course, even some of the volatility measures out there, like the VIX, while elevated, nowhere near those sort of death-defying spikes that we've seen in the past.
We don't see anything, and what we do see is the same pattern repeating again and again, which is this buying the dip, as you noted. We know that's coming out of the $7 trillion in money market funds plus. And when gold is reaching new highs, Bitcoin's reaching new highs, there is this massive sense of FOMO developing that there needs to be a decent return net of inflation that can bolster in compounded way those portfolios. So that technical factor should never be underestimated at the moment.
I do want to go back to what you were saying about First Brands, whether or not this is a warning sign for the credit market. We know that spreads have been incredibly tight wherever you look, it feels like. So, Aoifinn, expand on that a little bit. I mean, how concerned should we be?
I think what concerns me most and us most about this First Brand situation is clearly the due diligence was not done. Clearly there were not the digging, that every stone was not unturned, was not turned over. And I think that's exactly the kind of pattern we saw in behavior in the lead up to the 2008 crisis. There was such a rush to put capital to work, such a thirst for yield, that there really was disregard for basic due diligence. And it's true that these may be de minimis amounts on the balance sheets of these banks that are looking pretty safe, pretty secure relative to how they looked in 2008, but that's still no excuse for shoddy due diligence practices. And I think if we see it here, it's pretty clear that it's not only going to be just here. So there may be this growth which allows us to kick the can down the road when it comes to the default cycle. But what does worry me is that clearly when so much capital is chasing a tight area, a crowded area of returns, there will be I's that are not dotted and T's that are not crossed. And that's clearly what happened here.
Right. It comes back to supply and demand. There are a lot of demand, limited supply, and maybe things get a little bit messy. You highlight, of course, the overarching fears that this is one of several shoes to drop. So we'll continue to follow that story. But Aoifinn, I'm really curious to get your views on gold at this juncture. It's what we keep talking about on this program. You see this rush into gold, this rush into cash. You have equities at all-time highs. How do you square those different circles?
It's very difficult to square because typically this would be the hedge. It is typically when gold would start to behave like this, when we have a lack of confidence in governments, in a currency debasement fear, which we're definitely seeing. And it is unusual to see everything running up at the same time. I think again, getting back to technicals, who's buying this gold? Yes, there will be some speculative interest, but a lot of it could be Chinese purchasing. And that probably is in exchange for not purchasing the dollar. So there are a number of things driving it. I think it certainly is a very consoling thing in that any investor that has a well-diversified portfolio is now seeing that portfolio is going to be performing well. And I do think that gold remains strong if we have that correction in equities that we've been forecasting for some time, but have yet to see.
I am curious what you think. I mean, the risks to this market are pretty well known, but at least right now it seems like a lot of investors are, if not ignoring it, certainly think that they can manage it. And I am curious if you see anything sort of really fundamentally changing investor sentiment.
I'd say at Moneta, what we're hearing is this ongoing disconnect between the sentiment on the ground, the consumer fearing for what AI is going to do to the job market, not necessarily to their jobs, but to their children's jobs. There's a massive, I think, concern around the next generation, the new graduates. Where are they going to work? So that concern is there. We know that inflation is continuing to bite. I just spoke with a group of investors in San Francisco last week, the most expensive city in North America. They're really feeling it at every part of the spectrum there. So I'd say there's a disconnect between that and the market being at all-time highs. And a comment that was actually made is it could be that the new generation cannot buy into the property market. They can at least put their savings and participate by being in the equity market. So there is a concern that we're not seeing something, and that's why we're really hunting for these canaries in the coal mine.
Yeah, absolutely. On Canary Watch, it certainly feels like that. I do want to talk a little bit more about AI and some of the mega deals that we've seen in that space. Of course, AMD and OpenAI, the talk of the town, a similar arrangement of sorts with NVIDIA. And Mandeep Singh basically told us to calm down from Bloomberg Intelligence. But it feels like you could build a case for getting concerned when you think about these fortunes of these companies becoming more closely tied together, Aoifinn.
Exactly. That kind of correlation, the ability of correlations to go to one, is a pattern that any of us market watchers will now well recognize. The phrases shell game, pyramid scheme, and house of cards have been thrown around with remarkable regularity when it comes to the recent AI deals. And I don't think anyone has actually picked apart these codependencies and what would happen if one were to collapse. We do know that the top 10 tech stocks are highly correlated, highly going to be a concentrated part of the S&P. So were there to be trouble there will be trouble elsewhere too. So I think we need to do that forensic analysis of these interactive acquisitions that we've just seen and really just see that part of the portfolio as having just more embedded risk.
Aoifinn, always a great conversation. Aoifinn Devitt, Senior Investment Advisor over at Moneta, counting us down to the closing bells. We're just about 2 minutes away from those bells. And right now we are looking at an S&P 500 at a record high. We're looking at a NASDAQ Composite and 100 at a record high. The Russell 2000 traded at a record high at one point on the day here. That is the setup into the close. A full breakdown of all of today's market action, that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. We're joined right now by Nora Melinda and Christine Aquino in today for Carol Massar and Tim Stenovic, taking a well-deserved short week here as we welcome our audiences across all of our Bloomberg platforms, our partnership with YouTube here, guys, on what's going to be another record-setting day for U.S. equities.
Another record day for U.S. equities. We're even seeing green across the screen. That's all Christine and I have been talking about all day today as we're sitting in for Carol and Tim, who are out headed to the Screen Time conference here. But it's really tech stocks that are continuing to propel these indexes higher. Heading into this year, you know, there was a bit of uncertainty, and there still remains uncertainty here, but you are still seeing a sense of bullishness, dip buyers coming out into the market, and a lot of people pouring some money into AI stocks.
Yeah, absolutely, Nora. But of course, we can't forget about the Federal Reserve. And we did hear from them as well regarding their September meeting. A lot of focus on inflation risks. You know, in the actual meeting itself at Jerome Powell's press conference, a lot of focus then on the risks to the labor market. But seems like at this point, maybe officials pushing back a little bit on the other side of their mandate, talking about the potential upside to inflation and what they're potentially going to be looking at doing from here in terms of rates.
Yeah, absolutely. absolutely. You have to wonder how much room they have to actually cut rates if, of course, inflation is pressured higher here. But at least for today, no one's really concerned about it. It's all about big tech, Romaine.
Yeah, I would like to forget about the Fed. Is that possible? They came out with minutes today, and of course they have some data coming next week that probably isn't going to come because of the government shutdown, and that basically leaves the market left to its own devices, at least until earnings season picks up. Here on this Wednesday afternoon, you are seeing green more or less across the screen. The S&P 500 decidedly in record territory, 67.53 and change as we wait for these numbers to settle, up about 39 points or 0.6%. The NASDAQ composite adding more than 200 points or 1% on the day. A 300-point gain for the NASDAQ 100, 1% on the day, both at record highs. It looks like the Dow Jones Industrial Average is going to close basically unchanged on the day. And the Russell 2000 participating in the action as well, a gain of about 26 points here on the day, 1%, and just about 4 points shy of its most recent record high.
And digging a bit deeper into where a lot of these stocks landed here, particularly in the S&P 500, we've got about 263 that settled up in the green, 237 down here, only 3 unchanged.
All right, it's circle time. Let's take a look at the sectors right now. More green.
Is this an osoboro, or what is it? Osobuco?
Ouroboros. It's a snake that eats itself. Well, maybe it is what you're seeing today, at least when it comes to the tech sector. But that's what's outperforming. Tech up 1.5%.
Then what is osobuco? Is that something different?
I think that has to do with meat and like maybe eating the marrow out of a bone. But industrials also had a great day, Romaine. Your second best performing sector on the day. What didn't do too hot? Financials, that was your biggest loss leader, at least from a points basis. We know that big bank earnings kick off pretty soon. Consumer staples, energy, and real estate also falling a bit.
And we just heard from Betsy Graseck over at Morgan Stanley. She's actually pretty bullish about this earnings season for banks.
Yeah, big time.
Yeah, for big
She
banks.
told us to buckle up.
She did. I'm buckled.
Well,
What's next?
Let's take a look at some of the gainers that we saw in the S&P 500. A few of them to look at. AST Space Mobile. This is a company that really spends a lot of its time in space. It actually has a strong competition here with SpaceX, their Starlink there. So we did see shares climbing earlier for double-digit gains, but closing about 8% higher at the closing bell. This is after the company signed an agreement with Verizon here to provide direct-to-cellular connectivity when needed for customers starting next year. So we had William Blair saying that this is really a competitive deal here for Verizon, specifically over SpaceX's Starlink here. So one to definitely follow. But of course, as we've been talking so much about AI, we cannot stop talking about that story here. Shares of AMD also in focus, up 11% today. I mean, this has been a company that we've been talking about quite some time as you think about it with the likes of NVIDIA and a few of its other peers. But the news today, of course, NVIDIA agreeing to invest as much as $100 billion in OpenAI to fund a data center build out. So of course, that's really the broader scope here. But this OpenAI is striking a deal with NVIDIA rival AMD to deploy tens of billions of dollars worth of chips here. OpenAI is poised to become one of AMD's largest shareholders, really seeing a buoy to the stock here. And lastly, let's look at the beauty space. I'm looking at shares of e.l.f. Beauty right now. Shares ended about 3% higher at the closing bell. It actually got a price target lift at Morgan Stanley. The analyst over there is really pointing toward a very strong launch for its Rhode brand at Sephora. I don't know if you guys are familiar. That's Hailey Bieber. Her makeup brand is called Rhode. Apparently, they had a very strong launch at the Sephora stores here. So you are seeing a lift as Morgan Stanley is pushing the price target up to a street high.
We're actually well versed in makeup over
Okay,
here,
yeah.
so.
How dare you?
Yeah.
We are.
All right, decliners, what's up?
Well, it's green and it's green, Katie, but there are a few stocks that fell today. One of them is Fair Isaac. You and I probably know that more commonly as FICO, and it's falling not because of news specific to FICO itself, but because of news from its competitor, Equifax, saying that it will offer its VantageScore 4.0 service to mortgage credit scores at $4.50 through the end of 2027. Remember, last week, FICO said that it will sell credit scores directly to mortgage resellers, and Equifax saying that its move is a direct response to what FICO is doing there. So it's a little bit of a tussle between credit score providers, a very interesting space there, but certainly FICO taking the brunt of that pain from that news today. Another decliner that I want to pay attention to today is, of course, Warner Brothers. Those shares down after we did get news. People familiar with saying that Paramount Skydance has discussed its interest in acquiring Warner Brothers Discovery with Legendary Entertainment and Apollo Global Management. Now, the talks seem to be related specifically to Legendary's investment in some key film franchises. Ever heard of Dune or Godzilla? So these are some of the assets that are potentially being discussed here. And the bottom line is this looks like is this going to be another delay to this potential acquisition? They were hoping to get this done before the Warner Brothers split in early 2026, but another roadblock in this process.
Have you actually seen Dune, Christine?
I saw it in theaters.
Oh, really?
You liked it?
I mean, it's interesting. Yeah, it's not my cup of tea necessarily.
So wouldn't watch it again?
Yeah, no, I wouldn't watch it again. I may have fallen asleep in the middle of it.
Oh,
I actually did fall asleep in theaters during Dune 2, but that's because we went to a midnight showing, and, you know, that's a young man's game. But great movie.
Well, there you go.
Yeah. How about that bond market, though?
Yeah, how about that bond market? Well, not a whole lot. I mean, I don't know if you heard, Katie Greifeld, but there was a tail on the most recent 10-year auction here. Actually, in all seriousness, though, you're not really seeing a whole lot of activity, a little bit of activity on the longer end of the curve, but that was mostly selling, pushing yields higher by about 2 basis points. A very, very modest bid on the long end of the curve with that 30-year yield just down less than a basis point. All right, guys, let's get to it. The most important news of the day right now. I got to catch a flight in a minute. Am I going to be able to get on it?
I mean, well, it depends on the airport you're going to, Romain, because what Christine and I have been looking at throughout the day, this news coming in that LaGuardia Airport flights are being temporarily halted. This due to a data outage. And it's just really interesting because throwback to, wasn't it Newark earlier this year that was experiencing some issues? Yeah. There's always some sort of issue here. It says flights into the airport were held after origin until 4 p.m., while departures were delayed by as much as 45 minutes, which, of course, you know, not terrible, but I mean, if you're looking to catch your flight and you're in a pinch here, this is not great news for those who are trying to get through the airport, right, Christine?
Have you been to the new LaGuardia yet? They've actually redesigned it. So it's actually, you know, if you are delayed, it's not like the hellscape.
The end of the world, right?
I mean, I was going to say, I was actually delayed for 6 hours there. It was not bad, you know? Yeah, because, you know, I was looking at the fountain. You can get cheesecake. You can get bagels.
Did you go to a lounge?
You can get drinks. I could have gone to a lounge, but, you know, we just hung out by the fountain. It's
and there you
cool.
go.
It's a great way to pass 6 hours of your time if you have to.
Certainly worse ways to spend 6 hours. Let's also circle back to one of the most read stories of the day. This about the Polymarket CEO. If you didn't know his name prior to this week, you probably learned about him.
I bet you he doesn't have to fly commercial.
No, his name is Shane Copland, and Bloomberg News crunched the numbers. Apparently, on the Bloomberg billionaires list, he is the youngest self-made billionaire. This comes after that ICE investment yesterday into Polymarket, $2 billion, valuing Polymarket itself.
You're talking about the Intercontinental Exchange, right?
Right,
okay,
yeah. You're right. Yeah, people keep pointing that out to me when I say ICE. But anyway, ICE investing $2 billion in Polymarket, bringing its valuation to a whopping $8 billion, a stunning amount. But it's made Shane Copland a very wealthy man.
Absolutely. Here, one of the most read stories on the day here as we round up our coverage here on The Close. That does it for our cross-platform coverage of the market close on Bloomberg Television, Bloomberg Radio, and our partnership with YouTube. And a reminder, Bloomberg Business Week, it's now on Bloomberg Originals. We'll be back tomorrow, same time, same place.
All right, coming up on The Close, as we grapple with a dearth of economic data, we'll discuss where the U.S. economy is right now with Torsten Slok. He is chief economist at Apollo. That conversation up next. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. Romain Bostic actually is catching a flight, so it's just me for the next 50 minutes. Let's take a look at where markets closed out the trading day. The S&P 500, a fresh all-time high. Investors rushing in to buy that dip that we saw yesterday, particularly when it comes to big tech. The Nasdaq 100 finishing the day higher by about 1.2%. But at the same time that you saw volatility leave the market as measured by the VIX down there, you can see that gold continued its record run, down. We are solidly above $4,000 per ounce. Gold up another 1.4%. But let's get back to big tech and some of the day's biggest movers. We have to start with AMD. This was the story yesterday, inking a deal with OpenAI, continuing to run higher, up another 11% today. NVIDIA also getting in on the action. NVIDIA, a rival to AMD, which has its own deal with OpenAI. It fell yesterday, up about 2.2% today. And then Jefferies, we're continuing to track the fallout from First Brands, really hitting Jefferies shares hard today, down almost 8%. But let's get back to our top story. And that, of course, is the deadlock in Washington gripping the labor market. More than 250,000 federal workers missed paychecks as the shutdown entered the second week, with 2 million more at risk. Now, this as tomorrow's jobless claims are expected to join the growing list of economic data delays. Carlisle, for its part, released its own read on the labor market, estimating just 17,000 jobs were created, among the weakest results since the U.S. economy emerged from the 2020 recession. So let's keep this conversation going now with Torsten Slok. He is chief economist over at Apollo. I'm pleased to say he joins me now on set. Torsten, it's great to see you.
Thanks for having me.
So this is the game that we're all playing, right? Trying to take these alternative pieces of data, since we don't get the U.S. official government data, and piece together a picture of the labor market, which prior to the shutdown we knew was weakening. So when you take a look at what you're seeing at Apollo, when you take a look at those alternative sources of data, what's your current read on where we are?
Well, your table really speaks for itself, because there is actually quite some variation already in what we have seen in the data for September. So the answer is that we just don't really know. Otherwise, we would obviously have a very strong number that we got last Friday. But now that that didn't come out and we're not even getting jobless claims, it does mean that there's just a lot more uncertainty about where we're going. But we do know, as you're saying, Katie, that we did go into the shutdown with some slower job growth. And that is, of course, the conversation in the market, namely the run up to where we are now, is that job growth has been slowing down.
Yeah, and you asked the question in a note this morning, basically, why are we seeing that slowing in job growth if you do have GDP that's still humming along here? And I'll just turn that question over to you.
Well, this is a very, very important issue, because if job growth is slow, simply because there's less immigration, simply because we have AI implementation, or for example, also because we have less government workers, that means that then the answer is that there's just labor supply is lower. In particular, immigration has slowed down dramatically from where we were for the last several years. And if immigration is slowing down and therefore there's less job growth, then the Fed can't do anything about that. The Fed shouldn't really be cutting just because of labor supply slowing down. If, on the other hand, labor is weakening because there's less labor demand, if companies are hiring fewer workers, if companies are seeing less consumption, less capex spending, then, of course, the Fed can lower interest rates in order to try to offset some of that. And given the divergence we're seeing between what's happening with GDP numbers, GDP for Q2 was 3.8. The Atlanta Fed GDP now, as we speak, is also 3.8 for Q3. Where is the slowdown outside of the labor market? That brings you to the conclusion that maybe the labor market is mainly slowing because immigration is slowing. And that means that maybe it's not necessary for the Fed to cut a number of times, because this is really just because there are fewer workers coming into the country.
You know, it's interesting when you phrase it that way. I hear what you're saying, but at the same time, it feels like everyone has a ton of anecdata at this point of knowing people who are looking for a job right now, whether they're a mid-career professional or they're fresh out of college. And it is just really brutal out there. It is hard to find a job.
I think also the labor market is stagnant because still of the uncertainty that came after Liberation Day. It sounds a little bit weird. Well, why are we still talking about something that's now 6 months ago? Liberation Day was 6 months ago. Are we still seeing the negative effects of that? Well, maybe companies are beginning to realize that this is a more permanent shock that they are facing with higher tariffs. And therefore, they are not hiring, they're not firing, and people are not quitting. So it is a stagnant labor market, while at the same time, there's less immigration. So that brings you to the conclusion that if the Fed starts cutting rates just because there's less immigration, while at the same time, all the data on my Bloomberg screen for consumption is still strong, the Red Book weekly data for consumer spending is still strong. You also look at the daily data for Open Table, how many people go to restaurants is still strong. The data for STAR, meaning how many people are staying at hotels, how many people are also going around to Broadway shows, to the movie theaters. You still see that economic data is still quite solid, combined with data center spending also being strong. I still come to the conclusion that maybe it's a little bit too early to declare that the economy is slowing down, because it is really only weak in the labor market because of the slow immigration, but it really is very strong almost everywhere else.
Well, let's translate that into a view on what the Fed is actually going to do, because I hear what you're saying. If they're cutting rates because supply is basically going down, maybe that's not a great reason. But we are in a situation where the Fed has restarted its rate cutting cycle. 2 more rate cuts are expected this year and then a whole bunch next year. And Torsten, it sounds like what you're saying is that when you look at the balance of this economy, that isn't necessarily the right move here.
That's exactly right. And the minutes that just came out here a few hours ago, they clearly said that now the FOMC is also worried about the upside risk to inflation. Yeah. So the Fed's dual mandate is the labor market and inflation. And now we have just concluded that the labor market might actually, yes, be slow, but this is probably mainly because immigration has slowed so much. There's data that showed that under the last several years, 2022, 23, 24, non-farm payrolls should have been around 200,000 because immigration was very high. Now, according to Wendy Edelberg and Tara Watson and Stan Voiker at the AI, they're saying it should be around 50,000. So we have a fairly sharp decline in the equilibrium level of non-farm payrolls. So if the labor market is actually still weak, mainly because of immigration, well, now the Fed is, with the minutes today, beginning to turn their attention to the other side of the dual mandate, say, well, there is some upside pressure on inflation coming from tariffs, also coming from a weaker dollar. So that's why maybe the Fed should, and that would be our view, begin to focus more on inflation and not forget that there's still some impulse coming on inflation. The consensus expects that inflation over the next 12 months will be 3%, which is still way above the Fed's 2% target. So the answer to your question, Katie, is I do absolutely think that the market is now beginning to turn more towards saying, hey, maybe the labor market is slow, but inflation is actually still here, and we still need to deal with that problem.
It's funny to hear you say that because I feel like we just switched off the baton. We were worried about inflation. Then it was the labor market that was really at the forefront. Now maybe inflation again. There's so much to dig into and not enough time. But I do want to get the government shutdown into this conversation because markets so far don't look that concerned. We're not getting the economic data that we love to dig into. But I am curious what this means for the Federal Reserve. We have a policy meeting coming up on the 29th. It looks like we're not going to get the CPI release that we were, or the inflation release we were expecting next week. We know the jobs market has been delayed when it comes to that official NFP release. When it comes to making policy, it feels like it just got a lot harder to do.
Well, with this shutdown, the Fed really is flying blind. And the consequence, of course, of that is that they do need to look at all these other data sources. There are other things to look at, but none of these can be mapped directly one-to-one into the government jobs data. So that's why both on CPI and on non-farm payrolls and a broad range of other indicators, we normally look at retail sales, durable goods. We just don't know, literally at the meeting on October the 29th, what truly has happened to the economy since the meeting that we had in September. So this is a very, very important conclusion. There's even been some debate around, okay, but how do you then communicate? Do you start talking about the private sector indicators? There's a broad range of things you can begin to look at. What do you put weight on? That debate at the press conference will become very, very important because if he begins to put weight on consumption, is it certain inflation indicators, is it certain labor market indicators, that will be very revealing for what they think is going on truly in the economy. So that's why it is a very problematic situation to make a decision on the back of very, very weak information.
And just under a minute left here, but I also wonder about the different elements of this shutdown where possibly we're not just talking about furloughs, we're talking about layoffs, we're talking about government workers potentially not getting back pay. What does that mean when you think about the long-term effects of this shutdown?
Yeah, because that then implies that suddenly we could have, that there could be weaker labor demand. And maybe it could be that the labor market now also starts to weaken because government jobs are going to weaken further. So it's just making the picture incredibly complex for the FOMC. And on top of that, we already had some dissents at the last meeting. So now they need to debate, well, what is the true state of the economy? And most importantly, how do we set and calibrate the Fed funds rate in response to the data that we think that we have?
Torsten, it's great to see you. Really enjoyed this conversation. That is Torsten Slok. He is the chief economist over at Apollo. Now coming up, the global head of BNY Investments and Wealth, Jose Minaya, he shares his market outlook in a conversation from the Greenwich Economic Forum. That conversation up next. This is The Close on Bloomberg. Welcome back to The Close. I'm Katie Greifeld. The S&P 500 closing the day in the green, up about 35% from its April lows now. And we saw, of course, that big recovery from that slight drawdown that we saw yesterday. A lot of that was led by big tech and those chip makers. That has been the story of the year when it comes to your mega caps. But you can see that the Russell 2000 also got in on the action. The little guys in that index up about 1%. And according to at least Jose Minaya, the global head of BNY Investments and Wealth, he thinks that this rally has more room to run. He spoke with our own Romain Bostic from the Greenwich Economic Forum. Here's part of that conversation.
Again, think about it, right? If you look at the markets today, they're doing pretty well. I would say the pace of growth has slowed down from what we saw in kind of the real boom years. And I think from a market perspective, it's pretty interesting. Like on one end of the coin, look, we were pretty constructive at the beginning of the year saying 6,400, 6,700 S&P. We've already said 7,400 next year. It'll probably beat that as well. Why? Well, look, when you look at earnings, and earnings, we're in another earnings cycle. I think you'll see companies beat earning expectations again. Balance sheets are pretty healthy. The banks are the healthiest they've been in my career. Consumer households. There's a long list of things that say the fundamentals in the market are very constructive. Then you look at the other side. You're like, okay, the list of things now that can go wrong. And every day you look at the news, there's something new, right? Then now it's like the Fed independence and some geopolitical issue, some policy issue. The tail risk side is pretty big. It's why you also have never seen, risk on assets going up, yet gold is on fire, right? And largely it's because that's an easier way to play that tail end of the curve, right? So that's out there, which then goes back to the conversation we're having around partnerships. There is an urgency now around, it's not this discussion around, do you want large caps or mid caps? Is it U.S. exceptionalism versus Europe? Like, yeah, we have folks that do that, and you have to do that every day. It is, how are you building your portfolio through these times? And you may say, yeah, it's what everyone, we've talked about it for a long time, but no one actually did it, right? Most people were in a barbell. I'll buy beta, and then on the other end, I can get alternatives. I think that portfolio construction is be a lot more complex.
I do have to ask you, though, about the idea of the affiliates that you have and whether there would maybe be some value in bringing them under the fold directly. So, you mentioned Pershing, you mentioned a few others. Has there been any discussion about doing that? Yeah, well, look, obviously I have a long history with affiliates and, from my time at Nuveen, and we have an affiliate and boutique model at BNY. And, look at it two ways. One, I would say, I look at investments like the factory floor, right? The manufacturing is the investment stuff. Like, that stuff doesn't get integrated or brought into anything. That's very unique, very separate. You want to keep the cultures. What gets brought in, and it's more important in today's environment, is, okay, how are we touching? I always used to say, every second hand on the clock, someone around this planet should be selling what we do. And the only way you can do that is to be connected at the top and have significant scale to do that. How we're thinking about our product ideation and creation has to be where who's spanning the globe looking at this, bring it back down. So there's bringing that together, but then there's also where, and look, BNY, great example, right? You'll hear Rob and Vince, our CEO, talk about that we're more of a platform operating, model. And what that means is, the stock went from $40 to 106, 107 in just under about 3 years. And you're like, best performing financial services stock out there by far, definitely across all the banks. That's simply taking these silos, right? Then breaking them down and saying, how do we lean into our competitive advantage and say, hey, we do own a Pershing, and there's some benefits to how we can better reach those clients. And we do own an asset servicer. We have a wealth business. We have a payments business as well. How do you bring all these things together? Because in a world where in the 80s, 90s, markets were just on fire, now you have to get more efficient and scale than what you do.
And that was Jose Minaya, global head of BNY Investments and Wealth, sitting down with Romain Bostic from the Greenwich Economic Forum. And coming up, NBA legend Shaquille O'Neal teaming up with Jorge Mora of Jacmel Partners. That conversation up next. This is The Close. Well, he's a 15-time NBA All-Star, a philanthropist, and now Shaquille O'Neal is stepping into the infrastructure space. The NBA legend is joining Jacmel Infrastructure as a founding partner. Earlier today, Romain spoke with Jorge Mora, co-managing partner at Jacmel Partners, and Shaq about why this new venture is personal.
Well, there's a tremendous need in the U.S. for better infrastructure. You see it in your roads, you see it in your airports, your train stations, and I want to help make that change. And, Jacmel is the partner that can help me do that. When I met Jorge and Nick, they approach me, and we kind of have the same values. I like to invest my time and money where it can make a difference in people's lives and have a positive impact on the community. So, I thought it was the right thing to do, because I live in a town where we definitely need better infrastructure. So if I could, partner with a company like Jacmel, I'll do it every time.
And a lot of cities, of course, across the U.S., Shaquille, are in that same position. I mean, one of the deals that the infrastructure project had been involved in was, of course, the redesign and redevelopment, if you will, of LaGuardia Airport in New York. And Shaq, I mean, as somebody who spent, 19, 20 years in the NBA, I'm sure you've been to pretty much every airport in the United States and beyond. When you look at the infrastructure in the transportation space, what does it say to you?
Man, it says that, whoever has the contract is doing a great job, and I know the work that Jacmel does. And my hometown is Newark, and part of that airport has already been redone. I would definitely love to be involved in, the expansion of that one. But, as long as we have companies like Jacmel doing their thing and, bringing what they bring to the table, it's beautiful. Saw what they did with LaGuardia. It's definitely why I wanted to be their teammates. Every time I win a championship, it's because I have great teammates. One with Kobe, I'm winning in a broadcast with your best friend, Charles Barkley. So I want to also win a championship in the infrastructure space.
So, Jorge, I am curious that with regards to the projects going on through the infrastructure fund, I mentioned, of course, what went on at LaGuardia, also a big project at JFK, Hartsfield down in Atlanta. Is your focus going to primarily be in, I guess, the aviation space, or are you looking to do something more broadly?
We're going to be looking at other spaces. I mean, the transportation space in particular is one of our core focuses. And we also recently did an investment into the energy space. Unfortunately, we can't disclose it, but it was a large, almost $100 million investment. And then we're also going to look at digital. What we try to do is we try to pair the competencies that we have in-house with the different sectors we're investing in. In the digital space, we happen to have a senior advisor who has done an enormous amount of investing in digital for the last 25 years. In transportation, we happen to own a design engineering firm that has worked in close to 100 airports in the U.S. And so we try to stick to what we know, what we can bring some added value. And then by having Shaquille as one of our founding partners, we can really focus on the community engagement into those big projects. We mentioned LaGuardia a couple of times. If you've flown in or out of LaGuardia, you can see that there's all these local businesses that are in the terminal, restaurants, et cetera. And it also has the impact on the employment in the community. So our value add is that we're going to try to bring that organic and more natural connectivity that a group like Jacmel can bring to a project like that when partnering with large infrastructure investors, either strategic or financial.
Well, expand on that a little bit, because, I mean, as someone who goes through LaGuardia almost every other week, it's very obvious that there is an intent with that redesign to highlight local businesses. And I am curious as to what that conversation looks like, Jorge. Are you're talking with the airport authority, or are you talking with just the local government leaders? What is that conversation?
It's a combination of all of that, right? It's understanding which businesses in the local community we want to bring in, what investors from the local community we would like to group into our investment group to just tie to the community, to make sure that their needs are being listened to. So in any new project, for example, Newark has been talked about. It hasn't been announced yet. Hopefully it will be in the next few months or year. When that happens, having Shaquille as our partner, having the fact that he grew up there, I think will give an edge to any group that we work with in delivering that community and engaging with them properly.
Maybe, Shaquille, you can talk just a little bit about Newark and your connections there. Obviously, you were raised there, and you've been a big investor there long prior to this deal with Jacmel.
Yeah, when I met with Jorge and Nick, I told them I wanted to do business that's going to have positive impact on local community. Born and raised in Newark, flew in and out of the Newark airport many times, and would love to be a part of this project. That just goes with legacy. You have a kid who was a medium juvenile delinquent. Now he's partnered with a company like Jacmel, and We're redoing the airport. We're making the airport better. So, this would be big if we could land that deal. But again, when I met with Nick and Jorge, I told them, I said, I want to have positive impact on local community. That's all we want to do. We want to, help create jobs. Just whatever it does to make the community better. That's definitely something I want to be a part of.
Do you have any ambitions for having more deeper ownership in the sports world in terms of sports franchises?
Actually, no. I've always been I can remember when I was taking my business marketing class, professor gave me a book on the side. He said it was the Dummy's Guide of Starting Your Own Business. And my favorite chapter was joint ventureship, because I realized that in order to be a great leader, you have to have people that are smarter than you as teammates. So I applied basketball to business, and I was like, you know what? I need to get guys that are better in whatever space I'm trying to invest in than I am. Imagine me trying to run the Five Guys by myself. Imagine me, trying to run Reebok by myself. Imagine me trying to do this infrastructure by myself. So you have to get great teammates. I mentioned this early. I won championships with Kobe Bryant, D. Wade. I'm winning with Ernie, Kenny, and Chuck. So, when it comes to, finding great partners, Jorge and Nick are the best in this business, and we will definitely win.
And that, of course, was Shaquille O'Neal, NBA legend and founding partner of Jacmel Infrastructure, alongside Jorge Mora, co-managing partner at Jacmel Partners. Meanwhile, let's get back to these markets. Take a look how they closed up on the day. A new all-time high for the S&P 500. That dip being bought in force, particularly when it comes to big tech. The Nasdaq 100 up about 1.2%. But it's really interesting, of course, what you're seeing in risk assets, what you're seeing in traditional havens, because even as volatility drains out, that bid into gold just keeps on going. Gold up another 1.4%. We are above 4,000. This is the close on Bloomberg.
The primary issue that is facing the market right now is that there is a lack of demand. There's inadequate demand, not inadequate supply. And we have to acknowledge that in the near term, if the focus is to depress cash flow, margins, share repurchases, that this is going to go diametrically opposed to what investors in this particular space are most looking for over the next few months.
That was Evercore ISI's Stephen Kim saying that the central issue facing the housing market right now is lacking demand. U.S. mortgage activity this morning confirming the market's momentum reversal, with a smaller drop in rates not enough to keep the fire burning. Joining us now is someone with a key perspective on the housing market. His name is Tarek Moussa. He is author and TV host of several HGTV hits, including Flipper Flop and Flipping 101. Great to have you on set with me.
Thank you. It's so nice to be here.
Yeah, so let's talk about what is going on in this housing market. There's a lot of different perspectives out there about why things still feel so stuck, and I'd love yours.
Well, I heard him say there's no demand. Well, I think there's more demand than we've ever had. I just think people can't afford to buy a house today.
Right.
And a stat came out, I think it was 2 months ago, that we were in the most unaffordable real estate market since 1984. So that's a very long time. And it was just changed, I think it was a week or two ago. I believe we're now in the most unaffordable real estate market in recorded U.S. history.
A lot of people anecdotally would agree with you, and I wonder what fixes this situation, because, okay, you're seeing the Fed starting to cut rates again, 25 basis points at a time. Maybe we'll see rates come down, but even if they do you just have a wall of buyers waiting on the other side that will push prices higher?
Okay, so I don't think prices are going to be pushed higher. I think that prices are going to go down a little bit, not very much, and I think by 2027, or 2026, things will be more stable. But at the end of the day, this happened almost overnight when they took interest rates from 3% to 7%. And then a big problem that we're seeing today is anyone that bought a house from 2021 to 2024, they're kind of in big trouble. And here's why. You know, the date the rate, everyone that thought they were going to date the rate, they're now marrying the rate. Why is that? Well, if they bought a house for $300,000, they put 3% down, that's $9,000. What happens if the property value drops 10%? They can't sell their house. And even if the rates went to 2%, they're stuck at 7% because the loan to value isn't there.
Well, when it comes to property values dropping 10% in your hypothetical there, is that hypothetical or are we starting to see some of that?
Oh, we're already seeing more than 10%. If you look at markets like San Francisco, Austin, Texas, Phoenix, Arizona, I mean, if you look at properties in San Francisco right now, which, by the way, I think San Francisco is about to blow up when it comes to real estate, because properties are selling for what they were selling for sometimes 8 to 10 years ago.
Interesting. So you mean blow up in a bad way?
In a good way.
Oh, in a good
I think,
way.
yeah, because what I'm saying is San Francisco has been so depressed so long, it's about to explode. Now, who's in trouble? Texas, Florida, Arizona. Why? During the pandemic, during those years, the amount of demand into those markets exploded. And now the demand is no longer there. People are trying to get out of there. They're listing their homes. There's too much supply. People want to buy, but they can't buy for one single reason. They can't afford it.
Yeah. Well, let's talk specifically about Hoboken, New Jersey, because I would love to buy a house, Tarek. I feel like I'm trapped in this endless cycle of renting, and there's different ways you can go about it. You can try to time the market, wait for rates to come down, but I mean, what breaks the cycle here? Okay,
well, the cycle's about to break,
Okay.
and I'm just going to say it. The real estate industry, I'm talking about real estate agents, I'm talking about loan officers, escrow officers, title officers, they're going to agree with me right now. The industry has been in a recession since the spring of 2022. We are going into fourth quarter of 2025. Spring 2026 is around the corner, which means our industry has been in a recession for almost 4 years. So if you were to ask me what's coming next, the opposite. I think real estate is going to flourish again. Do I think it's going to happen tomorrow? No. Do I think it's around the corner? Yes. So everyone that's been sitting on the sidelines waiting to buy, I believe that opportunity is going to be, honestly, November, December 2025 through early 2026.
All right. Well, my lease is up at the end of May 2026. So I feel like January, February is when I need to start getting serious. But I want to go to this point in your notes that the best real estate buys today are new construction. That is really interesting because you think about the cost of raw materials, of course, with the U.S. trade posture right now, they've been going higher.
Yeah, it has nothing to do with that.
Interesting.
Has nothing to do with tariffs, has nothing to do with the cost of materials, has to do with the fact that a real estate builder is in business and their job is to move inventory. A homeowner is emotional and they might not want to drop their prices. So what's happening is builders, they don't want to lower their prices because it hurts their appraisals, but maybe they'll give you free grass, maybe they'll upgrade your tile, maybe they'll give you free appliances. So we actually had, I think it was a 20% increase in new construction closes in August of 2025, and at the same time, August 2025, one out of every 7 escrows were canceled.
So there you have it. Before we let you go, you mentioned tracking the migratory patterns that we saw during the pandemic. You saw a lot of folks move out of, traditional city centers, San Francisco being one of them, into the South, Texas, Florida. Maybe that's starting to reverse. What does that mean for where we're sitting right now when you think about the New York City metropolitan area?
I think I have a really good pulse on what's happening in this country when it comes to real estate. And the number one reason why is because I go on TikTok Live every single day, and I talk to at least 50 to 100,000 people about real estate on the East Coast, on the West Coast, all over the country. And I think the real estate market, I think we're at the end of this thing. I really, really do. Here's what I think. The Great Recession literally killed the American family. And the only reason we're in this situation is because the rates went from 3 to 7. And if things got nasty, do I think that they would drop the rates? I do, because there's no way they would put us into a back-to-back Great Recession.
All right, Tarek, unfortunately, we have to leave it there. Really enjoyed this conversation. Looking forward to following you on TikTok, but also on traditional TV as well. That is Tarek El Moussa. He is a real estate expert, author, and of course, a TV host over on HGTV. Now, still ahead, fantasy football is fueling demand over at Cameo, the marketplace for personalized videos from celebrities. We'll talk to the CEO next. This is The Close. Well, fantasy football season is taking Cameo by storm. The marketplace for celebrity video shout-outs seeing a spike in business as fans book their favorite athletes and personalities to talk smack and celebrate their wins. Joining us live on set, I'm pleased to say, we have Cameo CEO and co-founder Stephen Galanis. Stephen, great to see you in person.
Thanks for having me.
So let's talk about fantasy football. I have to imagine it's always pretty popular, but particularly popular this year.
Yeah, over the last 5 years, we've seen fantasy football on Cameo become a bigger and bigger part of our business. In fact, this year, for the first time ever, it was bigger than Mother's Day, which is now the biggest and busiest time of our year of anything other than the Thanksgiving to Christmas season, when we do 30% of all of our orders. This first use case that pops up in fantasy football are leagues booking people like Scott Hansen or John Gruden to select their draft order. And one of the reasons we think this is really popular is because every video by default is shared with 10 or 12 other people who are all eagerly awaiting to see where they're going to draft. And what we've seen is this kind of compound year after year after year. And because most fantasy football players are pretty avid, they're in multiple leagues, what they do in one league becomes their idea for the other two that they play in.
And for those who aren't familiar, just talk us through how exactly it works. So do you have a roster, so to speak, of talent on the Cameo app that folks can click through, or how exactly does that function?
Yeah, we do. We have over 60,000 athletes, actors, celebrities globally on the platform. So somebody would come on, search NFL or search football, find people that might be really relevant to the teams that they like or the people that they watch on TV, and then they can put the request in. They can put information about the team names, put little jokes in, and then let them do their thing.
Yeah, let it rip there. So are you in the business of, trying to recruit talent, some of these personalities and celebrities onto the platform? What does that look like?
Yeah, absolutely. There's three main ways that people join Cameo. First, our team will go reach out to people that we see search data for or that are just obvious. And last year, getting John Gruden on was a really big one. And he's been the #1 fantasy football earner on Cameo for the last 2 years. Secondly, there's talent-to-talent referrals. So when John came on, he actually referred his brother Jay, who also does really well on the platform. And then third, if we missed you somehow, you can just sign up cameo.com/enroll and start making videos on your own.
That's funny. You can sign yourself up there. So talk us through how exactly Cameo profits. Do you just take a portion of whatever is paid to the talent?
Exactly. We have a fixed booking fee on every single video.
Yeah, okay. So fantasy football, obviously, that has been a smash success for you. Can you anticipate these things? Fantasy football, obviously, in the limelight right now, but I mean, as we move into the holidays or other cultural moments, how much visibility do you have over what's going to be popular?
Well, we get a lot because the search data on Cameo is really a window into the zeitgeist. So the second something is trending or there's a new show that drops on Netflix or somebody's going viral on TikTok, we see it in our search data. And if we don't have those people on the platform, we go get them. Probably the best example of this was during COVID, when all of a sudden we woke up and we had never heard of people like Carol Baskins or Joe Exotic. And within 24 hours, we had a lot of the Tiger King cast on Cameo the minute it was there. So, we do not make pop culture, we reflect it. And the second somebody's trending, we get them on the platform.
I love that idea. You just hold a mirror up and you see what shows up there. So obviously COVID, of course, was huge for you. I feel like that's really when Cameo became ubiquitous and became part of our vernacular and our language. So just talk to us about the experience of keeping the momentum going once people started going outside their homes, once we weren't as much on our phones as we all are now.
Yeah, Cameo was growing really fast coming into COVID, but in 2020, we had a 500% revenue growth year. So you can imagine that's pretty tough to sustain. And, we went through some tougher years in the immediate aftermath as people stopped. They could go to games again, they could travel, they could go to dinner. They didn't have to send a virtual birthday message, they could go spend time with them. And the cool thing is, what we've seen in the last 2 years is really, we hit a bottom, we've come back up, and right now the business is as strong as it's ever been.
And how important is social media to that sustainability, to that growth? Because you mentioned, of course, when there's a Cameo video, it's going to be shared to, a dozen people or so, but occasionally some of those will go viral on places like TikTok, and I have to imagine that's pretty important here.
It's everything. TikTok, Instagram, those are the rails upon which our talent are built. And what we see broadly are people go on TikTok or Instagram to get famous, but the monetization of those platforms is not great. So once they have a following, they come to Cameo. And our value prop to talent is they're getting paid to become more famous and more beloved. Because when you get a Cameo from someone, you like them more than you liked them before. And statistically speaking, you're going to share it on social, and then that becomes a commercial for the next one.
All right, Stephen, great to get some time with you. Really appreciate you stopping by. That is Cameo CEO and co-founder Stephen Galanis. Meanwhile, let's look ahead to what else we're watching over the next 24 hours and set you up there. We're still eyeing that U.S. government shutdown. And as such, we're expecting delays to U.S. wholesale inventories, initial jobless claims, of course, crucial reads on where we are in this economy, in this labor market. But investors just going to have to sit tight. But the good news is that corporate America still has something to say. We do get earnings from the likes of PepsiCo, from the likes of Delta, a really important read on consumer demand here for beverages and food, but also for travel, specifically for air travel. We're also going to hear from Fed Chair Jerome Powell at 8:30 in the morning, delivering pre-recorded remarks at a community banking conference. But also Treasury Secretary Scott Bessent and Fed Governor Michelle Bowman will hold a fireside chat there. Certainly going to make some news, I would suspect. And we also have other Fed speakers in the form of Kashkari, Barr, and Daly, all beating the drum until we get that Fed meeting later this month in the absence of that government data. Take a look at where markets ended on the day. You can see it was an up arrow day across the board, including for gold, really extending that record rally, now above 4,000. That does it for us. Balance of Power is up next with a conversation with House Speaker Mike Johnson. Have a great evening. This is Bloomberg.